Hey, my friend, Barry Burns here with TopDogTrading.com, and today I'm going to answer a question that has come in fairly frequently recently, and it's really a good question, so I want to let you guys know I appreciate your questions, and here it is. The question is, when we get a very aggressive move up, how can we find opportunities to enter? So in this case, for example, we get a move down from here to up to here, and it is a very sharp angle, right? More than a 45-degree angle, and it's a very aggressive move, and it is fast and furious. One of the ways to see these kind of moves, to identify them, is to draw rectangles from the bottom to the top, and with that time. And if you've got more, in other words, if it's higher than it is wide, in other words, it's higher here than it is wide there, then that means it's a very, very aggressive move because it's going up, it's covering more price over a shorter period of time. Basic XY axis analysis, right? So, by the way, very, very important. So many people look at the time axis, of course. Well, no, very few people look at the time axis, I should say. But everybody looks at the price axis. In other words, everybody's looking at price patterns, support resistance levels, indicators that calculate things based on price. And that's all great. You should. You absolutely have to. Absolutely. However, the problem is I find that very few people focus on time, the x-axis. Well, they've just never really been taught it. And boy, that is a huge mistake. If you haven't delved into that yet, please do, because that's half of the chart, right? A chart is a two-dimensional object. You got price and time. That's it. So if you ignore the time aspect of the chart, the y or the x-axis in this case, then you're literally leaving out 50% of the information on the two-dimensional object. How can you therefore establish a probability scenario if you're leaving out 50%? So anyway, dive into that. Actually, I've got a tool for that, my free cycle indicator. And yeah, I'll be happy to share that with you for free. If you're interested, just send an email to Barry@TopDogTrading.com and request it via email, and we'll send you the information over about that. Absolutely free with the tutorial and no obligation. Okay, so but anyway, this is one lesson on time and price here that I'm giving you right at this moment. So it's spending a short amount of time covering a large amount of price. So that's a very aggressive move, And we don't get any real retraces here. So people who like to buy retraces in an uptrend, well, dang, where are the retraces? There's really no retraces coming in here to buy again. But there are. And we just have to go to a different time frame in order to identify them. Now, in this particular example, you can see that I'm looking at the NASDAQ futures, and this here happens to be a 6-minute chart, but don't get caught up on that. This is a universal approach and principle that can be applied to any market you trade, whether it's stocks, Forex, futures, whatever, and you can apply it to different time frames. But the key is what we do is we drill down to a shorter time frame. All right, so again, this is a 6-minute, so now we're going to look at a 2-minute chart during the same period of time. And just for your reference, note that, well, actually, you can't see the timestamps on there. Wait, maybe I can move this up so you can. There we go. I just figured out how to do it. Okay, so let me just show you the time frame here. So basically, yeah, from 9 to about 11, about 2 hours, it goes up. If you wanted to start back here, you could. That'd be about 8 o'clock. Okay, but anyway, that's our time reference. So, yeah, it actually does start about 8 o'clock here. All right, now let me bring up the 2-minute. So here we have the 2-minute chart. And as you can see, so here's 9 o'clock. There's 11 o'clock, just to mark those general times. And now, as you can see, during the same period of time, we get swings. In the last one, we had no waves, no swing high, swing lows. Here we get up move, down 1, 2, 3, 4, 5, failed 7, goes down to 6, full 7, 8, and 9. So this is how, when you see a very extreme, very steep angled move, very aggressive move, and you don't see any retraces, how you can then look at a different time frame from a different perspective, and you can actually get entries. Just drill down to a shorter time frame. And now, I would recommend, last thing that I'll say about this is the ratio of the two time frames. I prefer a 1-to-3 time ratio. So that's why I used a 2-minute and a 6-minute chart here, 1-to-3 ratio. 1-to-4 is also okay. So if I was using as a 2-minute, I could also use a 8-minute if we're going to do 1-to-4. Now, if we wanted to go 1-to-5, we'd go 2-minute to 10-minute. I don't find that works very well. So 1-to-5 ratio, to me, there's too much disparity. In other words, the 10-minute is just too darn slow compared to the 2-minute. So 1-to-5 ratio, no, not so good, not so bueno. And I know a lot of people will do that. They'll use like a 1-hour chart and a daily chart. Okay, I think that's kind of ridiculous personally, because the daily chart's just going to move so slow. That's really not providing a timely signal, timely confirmation. In the two, there's going to be too much movement within the shorter term time frame to give you accuracy and precision of the entries for the longer term time frame. So for me, 1-to-3 is the optimal ratio. 1-to-4 is okay. Beyond that, I wouldn't do it personally. And I've tried it regardless of the time intervals. It's just purely the ratio. You want them to synchronize enough, be tightly correlated, in other words, and not for the longer one to be so much slower. All right, so now we're going to do a part 2 on this video as well, by the way, so you can look forward to part 2. In part 2, we will talk about the opposite. So this one was how to use two time frames to get in to an aggressive move. Now, part 2 will be about, all right, if let's say we're doing the opposite, and we're looking at a short-term time frame like this, how would we determine that the market's not really going to keep going up any further than that? And then we look to the long-term chart. But our time is up for this video, so we'll look at that on the next video on YouTube here. All right, so if you like this video, please let me know. Give me a nice comment. Let me know. Keep me encouraged. That allows me to stay motivated to continue to provide free video tutorials, stumbling over my words here, free video tutorials for you into the future, which I enjoy doing. Just want to make sure that you guys are, getting benefit from them, and give it a thumbs up and also, oh, by the way, after a thumbs up, if you could just share the video, that would be really the best way you can pay it forward. Not only is it the best compliment for me, but it's also a way of, sharing the love, helping others, right? Share good things with good people. And also, I do have a complete course that I'm going to give you for absolutely free. Well, I guess a free course is free. That's very redundant. But anyway, good thing you don't have to be a good speaker to be a good trader. Otherwise, you'd be in big trouble today. But I love doing these things for you, and I have a great course for you too. And it's about how professionals trade differently than amateurs. And that's what it focuses on. It's got 5 videos in it. And in those 5 videos, I also give you one of my favorite trade strategies. So it's not just theories or ideas, but I'm actually going to give you a trade setup that you can actually start trading. It's called my rubber band trade. And you can get the rubber band trade by clicking on the little icon there, the little image in the top right-hand corner of this video. And you'll be sent to a page there where you can log into the course. And again, no charge for that. That's my gift to you.